All right, so today, as I said, what we're going to do is we're going to understand how to analyze ROIC, and we're going to put ROIC into a tree format to evaluate its drivers. So, a little terminology. On the tree, EOY stands for end of year ROIC. I mentioned that in the video. Versus BOY, which is beginning of year ROIC, which you've been doing on your homework assignment and which you will do on your midterm. Okay, so end of year is basically current year NOPLAT divided by current year ROIC. So the idea is we want to understand what a company's ROIC is and how it's changing over time. So the ROIC trees that we're going to build are 5 years of historical data. And specifically, it's to answer the question, how has the company's ROIC changed over the last 5 years? So in this case, we'll look at McDonald's. And we can see that in 2010, this goes through 2010 through 2014 data, 2010, McDonald's historical ROIC was 21.8%. In 2014, McDonald's ROIC went to 18.9%. The number below that is the 5-year percentage change. So McDonald's ROIC went down by 13.6%. And then we can see the year-by-year changes. So 2010 to 11, 21.8 to 23.5. Then 2012, it fell to 21.4. 2013 stayed relatively flat at 21.1. 2014 fell dramatically to 18.9. Okay, so that's the first thing that we notice about McDonald's ROIC is it has been worsening over the last 5 years. Its after-tax ROIC fell by 13.6% from 21.8 to 18.9. You will notice that I am referring to numbers as I'm walking through the tree, and that is intentional. So, very important in this class. This will be, by the way, one of the midterm essay questions. You will get a tree, you will have to analyze it. Okay? So, as part of the analysis on any graded assignment in this class, if you just say directional data without referring to numbers, I've instructed the TAs to give you zeros on any of those assignments. You get no credit, okay? Because here's the idea. If I say McDonald's ROIC got worse over time, well, guess what? I could flip a coin. And 50% of the time I will be right, and 50% of the time I will be wrong. Well, that's not an understanding of the analysis. So just saying that ROIC is improving or something else is happening, general trends, like that doesn't tell me that you actually understand anything in the subject, and I can't give you credit for the semester by doing that. Therefore, in this class, to get credit, not only must you say McDonald's ROIC went down, but you got to tell me what numbers you're referring to make sure that I understand you know what you're talking about. So I'm doing it intentionally, and you need to learn how to do it intentionally when you talk in this class. So therefore, ROIC at McDonald's went from 21.8 to 18.9, a decline of 13.6. Right? By the way, this helps you in the real world as well. Right? Because when you give presentations that are data dense and you start talking generally, people's eyes will glaze over and they'll have no idea what you're talking about. If I give you numbers, you can be able to follow along what I'm doing. It also helps your credibility. So it is actually very good practice, even for the interview process. And it will distinguish you from other students, by the way. So back to this. What drives ROIC to change is the next question. And so this tree is broken into what we'll call 2 levels of analysis. And this is true for any manufacturing or service company. Banks, financial services are unique. We're not really covering them this semester. But basically, for manufacturing service companies, 3 things drive ROIC. That's the first level of the tree, and that's what we're trying to understand what's causing the changes of ROIC, in this case for McDonald's. Driver number 1, tax rate. On this slide, it's called the cash tax rate. We're going to use the effective tax rate, but the idea is what rate of cash taxes are the companies actually paying? So, in this case, in 2010, McDonald's cash effective tax rate was 29.3%. In 2014, it was 35.5%. So McDonald's taxes that they paid, tax rate, went up by about 21%. Now the question is, did that help or hurt McDonald's ROIC? What do you think? Did that make the ROIC better or worse? which make it worse. If I pay more taxes, my ROIC is going to be worse. So that's what I mean by one of the drivers. So here's what we can say. One of the reasons that McDonald's ROIC actually went down over the last 5 years is because their taxes went up by 21%, because they went from paying a tax rate of 29.3 to 35.5. Right? And we can see over time, 29.3 to 31 to 32 to 32 to 35. So the tax rate's been steadily increasing, and that's one of the reasons why the ROIC is going down. So then the question is the reason the ROIC is going down just the taxes, or is the actual performance of McDonald's, the actual stores, getting worse? So now we want to look at the pre-tax ROIC. So that's the point. That's why we're going to separate out ROIC and after-tax ROIC, because the after-tax is tax affected, but pre-tax is the performance of the actual business. So in this case, McDonald's is doing worse because they're paying more taxes. That's important to know, but it doesn't mean that their stores are actually getting worse. So now we're going to look at the pre-tax ROIC, and we can see that in 2010, the stores were making 30.9%, and by 2014, they're making 29.2%. So the pre-tax ROIC did go down by 5.4%. So the performance of McDonald's operations is a little bit worse. But to be honest with you, if you really think about it, taxes are where they really took the most hit during this period of time, not the performance of the stores. Now, it's not saying that the performance of McDonald's themselves didn't get a little worse, because they did go down by 5.4%, okay? Which leads to the next two drivers 2 and 3, which is, on the last lecture, we talked about how the drivers of ROIC are margin and cycle time, okay? Margin was the profitability, cycle time was the productivity. That's what these two drivers are. Operating margin is the profitability or profit margin of the firm per dollar per unit of sales. It is the EBIT or operating profit divided by sales. Okay? So, in McDonald's case, in 2010, the operating margin of McDonald's was 31%, 31 cents per dollar. In 2014, EBIT divided by sales was 29%, 29 cents per dollar. Went down by 6.7%. Is that good or bad for ROIC over the 5 years? 2010 versus 2014. Does that help or hurt the ROIC? It's going to hurt it. Okay? So another reason why the pre-tax ROIC went down, and therefore the after-tax ROIC went down, is because they're less profitable on the food they sell. Okay? They're now making 29 cents per dollar of profit, operating profit, versus 31 cents selling the same stuff. So they are less profitable by 6.7%. Right? So that really hurt them in the stores. The final element, profitability times productivity equals ROIC, is productivity or efficiency. The formula that we gave you for cycle time is invested capital divided by sales times 365. On this ROIC tree, what I'm showing you is just the invested capital by sales divided by sales without multiplying by 365. All right, we're calling that productivity. And what it tells me is to generate a unit, or in this case, $1 of sales, how much did I have to spend in capital? In this case, invested capital, operating invested capital. All right, so in 2010, McDonald's, to generate $1 of sales, had to spend $1, 1.005 and a half cents on capital to generate $1 of sales. It's about a 1-to-1 ratio. In 2014, to generate $1 of sales, McDonald's had to spend 99.1 cents of capital. Right? That was a decline of 1.4%. Did that help or hurt McDonald's productivity? So is that more productive or less productive? That's more productive, because they're not using as much capital to sell the same amount of stuff. Right? That's 1 penny. It's not a huge amount, but it did help them. So therefore, did that help or hurt the ROIC? That's going to help the ROIC. Because if we don't use as much capital, then we're going to have less invested capital relative to our profit, which means we're going to have higher ROIC. Does everybody understand that? So, what caused the pre-tax ROIC to go down? Was it the profitability or the productivity? It was actually all the profitability because the productivity would have helped it. So here's what's interesting about McDonald's. What we now know is over this 5-year period of time, McDonald's performance was getting more challenged. And while they were getting more challenged, it was primarily because they were paying more in taxes. But underlying that, they were having some problems. And on the store level, the operating level, where they were having problems was actually in margin, not productivity of the capital. Because the productivity they were actually managing a little bit better, it was the decline in margin that really drive down their pre-tax ROIC, in this case by 5.4%. This is what I mean by the first level of analysis. What you have to do is you always have to talk about 3 drivers, because those 3 drivers will always, for operating performance, for, in particular, the manufacturing and service firms, explain the ROIC. Right? And that's what I'm showing you here, and that's what you got to start your analysis on. So you can always explain ROIC by talking about those 3 things. And that's what the tree is going to tell us over time how it's happening. Questions about what I'm calling the first level of analysis and the conclusions that we can now draw. Because very quickly, we now know some things about McDonald's. Even if you've never been to a McDonald's before, you already know what you're going to start to see just by looking at this statement. And this is, by the way, how analysts actually start preparing for the calls. Because I don't know why their margins went down. And that's actually the next point of financial statement analysis, is that financial statement analysis doesn't give you answers. What it gives you is more questions and more insight. So if I'm now on the conference call and I'm talking to McDonald's CEO, all right, what's been going on with your margins? What's causing that problem, right? And so I can actually start to see more clearly about the challenges McDonald's have, so I can actually develop better questions or go search for information. So again, questions about level 1 of the analysis. Now we're going to do what I call level 2. The margin went down by 6.7% over this 5-year period of time. What drives operating margin? That is the income statement. That's what these 3 items come from. These are the 3 key performance indicators off of the income statement. The first one is called gross margin, right? Some people call it gross profit. Gross margin is usually the gross profit as a percent. We call it the gross profit margin. But it's the gross profit as a percentage of sales. It's your gross margin, right? Second is SGA, which stands for Selling, General, and Administrative Expense. And the third driver off the income statement that drives EBIT or operating profit is depreciation as a percentage of sales. So all 3 of those are listed as a percentage of sales or a percentage of a dollar. Okay? Now, gross margin minus SG&A minus depreciation equals operating margin. Okay? So those 3 things determine your operating margin. Questions? Got my mouse here. So this minus this equals that. Okay? So, what is gross margin? Gross margin is price minus cost of goods sold, considering as a percentage. It's the difference between your price and your direct cost. Now, very important adjustment that we're making here. Buried in cost of goods sold is depreciation for most companies. And depreciation is a non-cash item. So what we're going to do is we're going to take depreciation out of cost of goods sold, unless it's already been taken out, and we're going to treat it separately in the depreciation line item. All right? Reason, depreciation is a non-cash expense. The rest of cost of goods sold is typically a cash expense. So cost of goods sold is often including cash and non-cash items. We are taking depreciation out of cost of goods sold, so it's a more representative cash cost of goods sold. Right? So if the company doesn't do that already, that's an adjustment we're going to make when we get to real-world financial statements. Questions? All right, SG&A, selling, general, and administrative expenses, again, typically cash expenses unless depreciation happens to be buried there, in which case we would have split it out. But the idea is The gross margin is indicative of our cash gross margin, cash markup, after the direct costs have been spent. The SG&A is the indirect cash cost. And by the way, those two together give you your EBITDA margin. Okay? Then you subtract out your non-cash depreciation, and that equals your operating margin. So again, three drivers. The first two are the cash drivers. The third is the non-cash driver. Okay? So let's talk about this. So from gross margin, McDonald's gross margin went from 45%, 45.3 cents per dollar in 2010 to 61.4, a 35% increase in gross margin. So that means they're getting a lot more markup on their food. All right? This is an example of where you got to be really careful when you do financial statement analysis, and you have to apply common sense. Otherwise, you're going to look like a fool. I don't want you to look like a fool. All right, so I'm going to show you how not to look like a fool, even though we're actually repeating these numbers. Because something's going on with McDonald's to see that big a jump in gross margin over 5 years. All right, number two, SG&A. 2010, they went from spending 9 cents in SG&A, spending 26.5 cents in SG&A. Selling general administrative is the marketing, distribution, R&D, sales expense, as well as overhead expense. Again, that seems like a very dramatic jump at McDonald's. All right. Depreciation. Depreciation is the spending on stores and equipment that's being spread out over time. That stayed relatively flat, 5.3 to 6, but it did go to 6 cents, an increase to 6%. When you subtract those three things, you get your operating margin. Now here's what's interesting. The gross margin went from 46 to 61. The SG&A went from 9 to 26. But if you look at the operating margin, it stayed pretty consistent over this 5-year period of time. So let's look at the intervening years. And we notice that what year did things kind of look different? Between 2011 and 2012? Everybody see the big jump in both those two numbers? So this is what I mean, you gotta be very careful. Because in this case, one of two things likely happened. Option one, McDonald's business model completely changed between 2011 and 2012, and suddenly they're getting a lot better margins on their food, but they're spending a lot more money to get it, and they're netting out the same thing. But they're really doing a completely different business model. That could be happening. Or somebody, whether it's Bloomberg or McDonald's itself, is reclassifying what it's putting into those two buckets on the accounting statement. And by reclassifying things, it's shifting things that used to be in cost of goods sold to SG&A. And they're actually netting out to the same margin. Which of those two do you think is more likely? One or two? Two. So this is what I mean by you got to be careful. Because if you were to say that McDonald's was basically getting a lot more margins on their food, then that would actually be wrong. And you would not look good. Because that's actually not what happened. What actually happened is there was a reclassification. Now that can happen from time to time, and here's an example where it did, and this is why you be very careful when you do financial statement analysis. So, Bloomberg was nice, they just gave us a bunch of swag, but Bloomberg will also hire you. And one of the jobs that you get hired on at Bloomberg is that when the 10 Qs come out, somebody has to map those 10 Qs to Bloomberg's database. And I want it to be consistent across companies. So in order to make it consistent, maybe I have to reclassify some items to make it look consistent with the way everybody else is handling the accounting. So it could have been a Bloomberg choice. Or, as you accountants know, accountants never follow the rules that they say they have to follow. There's always exceptions to the rules in what you call things. So maybe Bloomberg was then faced with a 10Q where the accountant started calling things different and somebody had to make discretion to make an apple and an orange actually fit into their database. So I don't know what the answer was, but I do know something really weird happened between those 2 years, but it doesn't really change the performance of McDonald's because the operating margin didn't really change over time. So I just got to be very careful when I do my analysis. So in this case, I'm going to shorten from 2012 to 2014 the performance of McDonald's pre-tax because that's more comparable. Because to be honest with you, 2010 and 2014 are an apple and an orange. It is not comparable on that second level of analysis. first level of analysis it is, because the operating margin was very consistent over the 5 years. But on the income statement, something changed. So in this case, let's look at what caused the changes between 12 and 14. And those are the more interesting years if you look at the trends, because the gross margin, the operating margin went from 31 to 32 to 31 to 31 to 29. So it was really in 13, 14 that the operating margin performance really started to worsen. So in this case, gross margin, 61.7, 61.6, 61.4. Those have been pretty consistent over the 3 years. Got a little bit worse, but not dramatically. We're talking about 0.3%. So basically, was it the markup on their food that caused the drop in operating profits? Yes or no? Is that the primary reason? No. The mark on the food, the gross margin, looks pretty consistent. SG&A, selling, general, administrative. That went from, in 2012, 25.1 to 26.5. They're spending an extra 1.5% on selling, general, administrative. That hurt their operating margin. So it wasn't the food. The problem is it looks like they were spending more to get people to come to the stores. And then we look at depreciation. So let's just talk about depreciation for a second. Depreciation is a fixed cost. Okay? What happens if sales go up and fixed costs don't change? What happens to cost per unit? If revenue goes up and depreciation doesn't change, what happens to your cost per unit? Goes down. Okay? So if your depreciation stays the same over time, that means as you spend more, you sell more. Right? So it means it's relatively consistent. So if depreciation goes from 5.3 cents in 2010 to 6 cents in 2014, and particularly from 5.2 in 2011 to 6 in 2014, 3 years of steadily increasing depreciation as a percentage of sales. It's going up by 13%. What does that really tell you is happening in McDonald's? First of all, is that helping or hurting their operating margin? It's hurting their operating margin. And what does it tell you about their store productivity? Because depreciation is property, plant, and equipment. So it's the stores, the stuff inside them. What's it say about store productivity? It's going down. So let's try and because finance eventually becomes about telling a story. So in this case, our story starts to look like the problem that McDonald's is having, and we now know with hindsight that it actually did happen, is they were having trouble with same-store sales. Right? People weren't going to McDonald's nearly as much as they did. And if we had done an EIC, one of the parts of EIC I'm eventually going to have you do is read industry reports. IBIS World is very helpful on the portal. What do you think you would have read about the industry that is hurting McDonald's? What's McDonald's macro problem? It's unhealthy. They're selling unhealthy food. And so people are going to other healthier alternatives, and so they're probably challenged with growth. And you're seeing it with the fact that the depreciation rates are going higher because they're basically not getting the productivity of the stores. If we were to investigate further, do you think McDonald's was opening up a lot of stores during this period of time? Opening up a lot of franchisees? No. So why would SG&A be going up? I'm sorry? Exactly. This is the story we're starting to see here, is that this is what I mean by the red flags. Before they went to all-day breakfast last year to kind of solve for this problem, we're actually starting to show up in 2014 in their numbers between 13 and 14 because we can see that their store productivity was being hurt a little bit. The depreciation was starting to go up relative to sales. And that going up tells me that they weren't getting as much out of what they spent. And they weren't spending on opening a lot of stores. So what it probably meant is sales weren't really going up. And what were they doing? They were trying to get people to come in. So they were probably spending on marketing to get people to come in to boost sales. And unfortunately, they weren't coming at the rate that they probably had hoped. And that's why their operating profit fell. It didn't fall because they were like lowering the prices on all their food. That's not what they were doing. They were trying to make the stuff cheaper. Everybody's trying to get you to come and buy it, and you just weren't coming at the rate. Now, it wasn't like sales fell off a cliff, but nonetheless, we can start to see that happening in their statements. Questions? This is what I'm telling you. We get a lot of information out of this tree. Some of it will involve questions, which involve research. And by the way, we did do this as a valuation exercise in the previous semester, so I knew a little bit more about this. But I'm just telling you that as an analyst, this is the finance person, once you have it in the statement, it really starts to put a better picture of what's happening with a company's financial performance into focus. Questions about what we just talked about, any assumption that we made, how we made it, what they mean. Because as I said, this will be on your midterm. Yes? Ideally, yes. At minimum, you just have to talk about the numbers. So if on the midterm you said that the SG&A was the primary reason that the operating margin fell, depreciation was number 2, and it wasn't really the gross margin, and you were specific in saying the SG&A went from 25.1 to 26.5. I won't give you something like this in the midterm, but nonetheless, if we went from 25.1 to 26.5, then that would be an acceptable answer. But ideally, that's what I said, what I'm preparing you for in this class is the real world. And in the real world, having some additional insights is actually extraordinarily valuable. This is what makes you a really good analyst, if you can actually relate it back to the real world. And that's what I'm saying. Sometimes I don't know the answer to these questions, but then I go find out. This is what I mean by it sets me up to, all right, now I know what to look for, my radar's on, and I can actually go start to search for those answers. Or ask the company about this if I'm an analyst. Or their competitors in some cases. All right. Second part is the balance sheet. Invested capital to sales of the pre-tax profit ROIC performance. So let's look at the productivity. 2010, we said it was $1.50. Went to 99.1, the productivity improved. 3 things that we know from our conversions that drive invested capital. 1, OpWC stands for operating working capital. Right? Primarily, it's going to be receivables, payables, and inventory. Right? Second, PP&E, property, plant, and equipment, both as a percentage of sales. The third one is intangibles as a percentage of sales. Where does an intangible come from? What is an intangible? Yeah. All right, it could be a brand, or, yeah, could be a patent, or trademark, or goodwill. Another example of an intangible. It's probably the biggest one for most companies. When does an intangible show up on your balance sheet? Yeah. If you buy it. So that's a very key point. If you build a brand, that doesn't show up on your balance sheet. If you create a patent, it doesn't show up on your balance sheet. It's only when you buy the IP from somebody else that it becomes on your balance sheet. And specifically, that purchase premium, it's called goodwill. So primarily for big companies, the biggest intangible is usually the purchase premium associated with acquisitions. So that's the key. And you know from your economic conversion and the book reading and the lecture I gave in the previous class on video that basically intangibles are operating invested capital. And it's the purchase premiums associated with that. And that's what's being represented on this tree. So 3 things. 1, working capital. 2, PP&E. 3, purchase premiums on acquisitions. So you add those 3 things together. 1 plus 2 plus 3, working capital, PP&E to sales, intangibles to sales, and you get invested capital to sales. So those are the 3 major parts of invested capital. So back to this. Working capital to sales. Is lower or higher better? From an ROIC perspective. Lower or higher working capital to sales? What's better? Lower. If you have lower working capital, you have less invested capital, which means you'll probably have a higher ROIC. Okay? So in 2010, they had negative 1.9 cents of working capital. In 2014, they had negative 0.3 cents of working capital. Is that better or worse? Is that better or worse? Is that better or worse? I don't hear unanimity in the class, for those of you listening on the video. In fact, I hear people, as I keep asking, they keep flipping their answer. Higher working capital, lower working capital, better. The sales. Lower working capital sales. They went from negative 1.9 to basically 0. Is that higher or lower? Is that change going higher or is that change going lower? That change is actually going higher. When you go from negative to less negative, so you got to think through these things, that means you're actually getting worse. Even though you have negative working capital, you have less negative working capital, which means you're putting more capital into your business. Everybody see that? So the productivity actually was worsening when it came to working capital by, in this case, now this is again, you got to be careful because it went down by 82%, but that's magnitude off of a small number to a small number could be a big change. Okay, so you got to be careful when you look at the percentages in terms of the total impact, because it really was essentially 1.6 cents per dollar of sales more of impact. So it was an impact, but the 82% could be misleading. Right.
Why is it negative?
Why is it working capital negative? Yeah. All right, so let's think about the three things, because I assume you've been to a McDonald's before. So one of the things is called receivables. So a lot of companies get paid in 30 days. Is that the case at McDonald's? Like when you buy a Big Mac meal, can you basically say, I'll just pay in 30 days? No, you're not going to leave without giving them a cash or credit card. Cash they get immediately, credit card within 2 days. So they're not going to have a lot of receivables. Second item on there is going to be the inventory. It's the food in the stores. Right, their inventory, the boxes, cups, stuff like that. So they're going to spend some money on that. And then the third item is accounts payable, which is when they pay the suppliers for the food and the cups. So if they have negative working capital, what does that mean? That means they have more accounts payable than more inventory. What does that probably mean? Let's say I get the food, and I'm not going to keep the food around for too long because it's going to spoil, and I sell the food in a week or two. When do I pay my supplier? Let's say I sell my food every 2 weeks, and I pay my supplier every 30 days. Think about that. Who's really funding the inventory in that circumstance? If I get the food and I sell it in 2 weeks, but I wait 30 days to get paid, who's funding my inventory? The supplier. The supplier is funding the inventory in that case. That's negative working capital. Negative working capital means more current liabilities than current assets. All right? Without looking at the balance sheet, we know they don't have a lot of receivables. All right? They're a cash business. So it's really inventory and paying the suppliers. And so in McDonald's case, they generally have a pay when paid philosophy. I'll pay you when I get paid. All right, so when I finish using the food, I'll pay you later. Okay? So, but here's the thing. What we can infer is that between 2010 and 2014, they weren't able to do as much of that as they used to. Because they used to have 2 cents more per dollar of sales of liabilities than assets. Now, they're about even on the two when you put them together. So it's getting a little bit tougher for them, right? For whatever reason. So maybe it's more inventory, maybe the supplier payment's down. Again, we can investigate. But this is what we're starting to see. Working capital is hurting them. Second, PP&E, property, plant, and equipment. All right, this is the spending on the stores, the equipment inside them, and any land that they might be buying. So, again, let's think about it this way. Property, plant, and equipment is typically a fixed cost. So just like we talked about depreciation, same thing should apply. If I see my sales go up and my store investment doesn't change, what should happen to my PPE to sales? It should go down. If I see my sales go down and my store investment doesn't change, my PP&E to sales should go up. If my PP&E sales goes up with sales, that means I'm kind of selling more and I'm investing more, or investing the same and selling the same if I'm not growing at all. So what's happening to PP&E to sales? Well, they went from 91.6 in 2010 to 89.5. Are the stores getting more or less productive? They're actually getting more productive. Because in 2010, to generate $1 sales, I had to spend 91.6 cents on PP&E. To generate the same dollar sales in 2014, I had to spend 89.5 cents on PP&E. I am 3% more productive with my stores. So, what's McDonald's real challenge here? Is it the number of stores or the stuff inside that they're selling the food, the inventory payables, the working capital? What's hurting their productivity? The inventory and the stuff inside, it's the working capital. What's helping their productivity? Stores. So they're probably not opening up a lot of stores, but the stuff inside, they're not selling as much of. This is where we started to see same-store sales for McDonald's start to decline. Because people were buying less food at McDonald's because they thought it was unhealthy. Not dramatically, but we're starting to see a shift. And this is, I'm telling you, the red flags were starting to show up in 2013, 2014 in their numbers for the eventual challenges that caused them to eventually go to all-day breakfast and kind of reorganize the way that they're marketing to consumers. Depreciation. Intangibles. Intangibles are, again, primarily spending in acquisitions. 10-7, 9-8, 10-2, 10-2, 10. It doesn't look like in that 5-year period they had spent a lot on intangibles because it didn't really change. Now think about this. I want to measure the impact of a synergy. Right? I buy a company because I assume they're going to sell more stuff. Right? So here's what that means. If the amount I pay for the company doesn't change, the premium, and I increase my sales, I would expect intangible to sales to go down over time. So one way as an analyst I can look at whether or not you're actually getting and achieving synergies is to see what happens with your intangible to sales over time. Because if that's going down, then that means your sales are probably going up relative to what you spent. Right? In McDonald's case, is that happening? It's going from 10-7 to 10. A little bit. Okay? So that's the point. They're not getting a dramatic increase in sales, but it also says during that 5-year period of time, it doesn't look like they did much in the way of acquisitions, with the possible exception of 2011 to 2012. So, back to pre-tax ROIC. Let's put these two analyses together. The productivity improved slightly from $1.50 to 99.1 by 1.4% because despite the worsening operating working capital to sales of negative 1.9 to 0.003 negative, the PP&E productivity and the intangible productivity going from 91.6 to 89.5 and 10.7 to 10 offset the working capital and allowed for slight improvement over McDonald's, but that was relatively small and it couldn't offset the decrease in the operating margin caused by the spending of SG&A, which caused their pre-tax margin to decline. You need to put a red thread through those stories and tie those things together. It will require practice and an understanding of this. And the good news is you got a week and a half to figure this out. Questions? Yes? We'll have what? No, I won't do that to you. But you will have a company that looks exactly like this. Like it'll look like this tree with these numbers. But I'm not going to throw you a curveball that says, here's something wacky that happened. Right? But you could see a dramatic change. And I'll give you another example. So one of the other companies we did last year was a company called Delta Airlines. And they actually saw a big change in their gross margin. Went up dramatically. Okay? Now, here's the thing. I don't think that that was an accounting error. Why? Yeah. Fuel prices went down dramatically. When oil went from 100 to 40, it really benefited the airlines. Because outside of labor, their next big cost is fuel. And so that was the point, is that they had a big drop in fuel costs, which was like increased their gross margin by like 20 percentage points. So every airline in the world saw a big jump in gross margin. And airlines are now printing money because they didn't lower their fares, but the cost of flying you went down dramatically. And so airlines are now making record profits because oil prices are low, right? And that's really good for the airlines. And it showed up not just in Delta, but then we checked a couple of the peers, American, United, whatever, and Southwest, and we all saw big jumps in gross margin. So it's pretty consistent across the board. So I don't think that was an accounting change. I think it was literally their costs really did fundamentally change. So that's what I'm saying. It could be that for a company. I'm not going to throw that to you on a midterm. I just want you to practice being able to do this. But once you get past the midterm and you pick a real company to analyze, God knows what you're going to find, right? Because that's the problem, is that we have to take what's given to us and we got to figure it out. Right? And sometimes it gets messy, right? But that's the fun part of the class. Get your hands dirty. All right. Questions? How about Chipotle? This is Chipotle before you knew that the stomach problems that you have were actually caused by E. coli. So this is just the 2010 to 2014 Chipotle before you realize the health problems I had in 2015. So that hadn't hit yet. So let's check Chipotle. You guys practice. Take a couple minutes. Practice looking at the tree, and let's talk about it. Mm-hmm. Nope. Tax rate has nothing to do with invested capital. Those two affect the pre-tax. Exactly. All right. Anybody want to tell me? Chipotle, end of year ROIC between 2010 and 2014 getting better or worse? Better. Why? I know it's repetitive, but somebody's got to say it. What's the numbers? Go ahead.
It went from 26.6% in 2010 to 40%
Exactly the type of answer I need you to make. Because that's what I said, now I know what you're talking about. All right, so listen, since you're doing a great job, what's the tax rate? Yes or no? That helped them.
Yes.
So the tax rate did help them.
Yeah, the tax rate helped them a little bit because it went from 38.1% in 2010 to 37.6% in 2014, which increased by 1.1%.
So is that a big deal to their improvement?
Not that much.
So it helped them, but not that much. So it was really the pre-tax improvement that was happening. So this is, again, very quickly. McDonald's was really hurt by the increase in taxes. Chipotle wasn't really helped all that much by their slight decrease in taxes. Right? So Chipotle's performance isn't because of taxes. McDonald's was a lot because of taxes. We clearly now see that by doing this analysis in two different companies, especially peers in the same industry. Right? So pre-tax ROIC went up dramatically by 52% from 43 to 63.5. Was it the margins or was it their productivity? Did the margins get better or worse for Chipotle? Better. 15.7 to 17.3. Did productivity get better or worse at Chipotle? They went from spending 36.5 cents per dollar to 26.4. Yeah, that's an absolute percentage change. Lower invested capital is actually better. Chipotle, I call in the last class the golden circle. they were doing everything right. They were getting less taxes, they were making more margins, and they were getting great productivity in their stores. It was all working in their favor. In fact, the margins improved by 10.4%. What drove it was gross margins actually went down a little bit from 30.4 to 29.9, but not much, still around 30 cents. What really helped Chipotle was the SG&As. It went from 11 to 9.9. Right? They got about a penny per dollar of sales out of SG&A, and depreciation went from 3.8 to 2.7, which actually suggests the opposite of McDonald's, which suggests store productivity. And I'm telling you, if you just look at any Chipotle prior to their problems, just how packed the lines were to go to the Chipotles. I mean, they're like Chick-fil-A's with the cars around the block, right? So that's what you were seeing there. So as they were growing, they were getting even more popular and even more people were going to them, and that was really benefiting them. On the balance sheet side, working capital sales went from negative 1.6 to negative 0.01. So like McDonald's, that kind of hurt them. But PP&E to sales went from 36.9 to 26.9. Great productivity of the stores. And intangibles really didn't change too much and went from 1.2 to 0.005. But they didn't do a lot of acquisitions historically, much less than McDonald's, by the way. McDonald's was 10 cents, they're about 1 cent. But it did improve intangibles, so they are getting productivity. So this is the point. Chipotle is the growth story. And it's a very profitable growth story. And it's actually firing on all cylinders, which is why it was so painful for investors when they had the food crisis with the E. coli scare, because that was unanticipated. Where McDonald's financial problems were actually somewhat anticipated because we started to see them in 2013 and 2014. So they didn't fall off a cliff, but at the same time, we could see that McDonald's was actually having trouble. With Chipotle, these were the glory days for them. They were just doing well on every financial metric. Okay? So, statement number 2, CFI, cash flow. We're going to go back to McDonald's. Again, you just did, and I'm sure you really enjoyed the financial statement analysis CFI conversion. Because everybody got that right, and you did it really quick, right? Sorry, I know you don't find my jokes too funny about that. Sure, it's painful and sensitive. But this is the benefit of doing it, is that once you're in this format, in this case you'll have 5 years of historical CFIs, then now we want to understand for McDonald's what's going on. So in this case, we'll have 5 years, and then I sum the 5 years into the total category. So the total is the sum of the 5 years, just kind of get a big picture. For purposes today, I'm just going to focus on the total, but when you do the analytics, which we'll continue to practice next week, you got to talk about all 5 years, just like we did in the tree. So I'm just doing it for time savings more than anything else, because we only have about 8 minutes left. Right? So with this in mind, 4 parts of CFI. Operating, which is called free cash flow, plus non-operating equals CFI, and that equals debt and equity. The first thing that we do, we got to analyze all 4 sections, is we start with free cash flow. And we can see that for McDonald's, their free cash flow over the last 5 years was $23,916.6 million. All right? That tells you something. That tells you that McDonald's did not need to borrow money, because free cash flow is profit, no plat, gross cash flow, minus investment in the balance sheet, reinvestment, equals free cash flow. After they reinvested, they had almost $24 billion of cash left. So they're generating a huge amount of cash at McDonald's. We clearly see this, which means that's what theoretically they're available to pay out. Matter of fact, the reinvestment rate is 31.7%. Gross investment in the business, working capital and CapEx, divided by gross cash flow, is the reinvestment rate, which for McDonald's was 31.7%. Which means for McDonald's, what's their payout rate? If the reinvestment rate is 31.7, what's the payout? The theoretical payout rate. What could they pay out if they wanted to? It's 1 minus the reinvestment rate is the payout rate. Therefore, 60, what is the number? Yeah, 60.3. Okay, so everybody see that? But this is, again, a very telling thing to look at, because I know that McDonald's is only reinvesting about 32% of the profits back into the business. 31.7 cents of every dollar. Okay? So, they're not doing a lot of acquisitions because I can see that in the intangible line. Because generally intangibles go up only when you buy more of them. Intangibles go down because you either sell stuff off or the accountants impair them. That's actually one of the flaws in our model that I don't have a good way to solve for. When we actually do the cash flows, the model treats a decline in intangibles as a cash flow. But if it's an impairment, it's not a cash flow. So we will have to then adjust it to add it back. Now, McDonald's, it's not happening very much, so I'm not really worried about a couple $100 billion given their size of their company, but it could be substantial for another company, and that's something we have to watch out for because that could actually make our cash flows look distorted. All right, so here's the point. They had $24 billion of free cash flow. Then what did they do with their non-operating cash? Right? Did they put it in the bank? Excess cash. What was the change in excess cash? So they put $188 million in excess cash in the bank. Not much out of $24 billion. Right? Now, in terms of non-operating assets, they got $1 billion from that. And they had a non-operating loss of $151 million. So they netted about $700 million of non-operating cash flow to basically turn their free cash flow from 23.9 to 24.7. Okay? Then I got $24 billion. Here's the point. If free cash flow is negative and CFI is negative, then where'd the money come from? Matter of fact, if free cash flow is negative, where'd the money come from? Either had to come from excess cash or had to come from debt or equity. If free cash flow is positive, where'd the money go? Either went into cash, well, we see it didn't clearly go into their cash balance, so what'd they do with it in their debt and equity? So, this is the other side of the statement, the financing side. After-tax interest expense, $1,730,000,000. So, definitely McDonald's paid off some interest on their debt. They used the cash to do it. Next line item, change in debt, $4,411,000,000. Did they pay off that debt or did they borrow new debt? Sorry? They borrowed new debt. So, example of an essay question I've asked for 6 consecutive years that I've said in class and 50% of you still miss it. It's even on the YouTube video and 50% of you will miss it on the midterm exam. So, I just realized you just don't pay attention to what I say, but that's okay. I can hear myself talk. So here's the point. Here's the question. Did McDonald's need to borrow $4 billion? Yes or no, and why? When they borrowed $4 billion in new debt, did they need to borrow it? Yes or no, or why? Yes. Exactly. If you have $24 billion of free cash flow, you don't need to borrow $4 billion worth of debt because you've generated $24 billion worth of cash. And you didn't do anything in the non-operating side, so you got $24 billion to pay out. So borrowing $4 billion is, by definition, discretionary. Right? And we're going to clearly see why it might be, but if you think about it, we're at all-time low of interest rates, ever. Why wouldn't McDonald's want to take advantage of that? And that's exactly what they did. They took advantage of capital structure. So that's the next thing we realize. They're doing this not because they needed to invest in a growth strategy, necessary. They're doing this because they're choosing to reinvest in a capital structure change, which will probably help them with their cost of capital and probably reward shareholders. But let's see, what they do with the money? Well, dividends, 14.2 billion dividends were paid out over 5 years. 2 lines down, share repurchase. They bought back $13.6 billion worth of common stock. By the way, when you add 14.2 and 13.6, what do you get approximately? What's 14.2 plus 13.6? Approximately 28. We'll round off. How much free cash flow approximately did they have? 24. What's the difference between I spent 28 and I only had 24? Where do you think the other 4 came from? Debt. Boom. There you go. This is what I'm telling you. There is so much insight in the CFI as to what a company's doing. And that's why we're putting it in this format, because it's very clear that yes, McDonald's had problems, but it's not like they're having huge problems. They're a cash generating machine. And what they're doing with their cash is they're rewarding their shareholders, not only with dividends, but they're also taking advantage of all-time low interest rates. Now, if you're the bank, are you worried about them borrowing the $4 billion? Why not? They could pay it back in 3 months or however long. Sorry, 3 years, a year, 1 year. Free cash flow in a year is, take it back. Free cash flow in a year is $6.7 billion of gross cash flow. They can pay it back in a year, right? So that's the point. The debt is not really a problem for McDonald's. And in McDonald's case, this is a discretionary reinvestment for capital structure. We can clearly see this. Questions about the analysis, because this is what I mean by the 4 parts of CFI. You got to tell me what's happening in operations. In the operating, you got to talk about free cash flow, positive or negative, because that gives you insight. If it's positive, you know the money went somewhere. Track it, where to go. And that's what's new in this class that nobody else teaches you, because everybody else stops at free cash flow. What I'm telling you is they're just giving up all of the insight of not following the money. By following the money, it tells you a lot more to the story. That's why you hate the conversion, but the conversion is very beneficial, right? But the flip side is when free cash flow is negative, same thing. Where did it come from? How did I fund that free cash flow? I clearly see where the money came from when I go through the statements. So, second, reinvestment rate. What's that tell me about their level of reinvestment versus payout? Then, if they paid it out, where did it go? If they reinvested, where did it come from? So, that's what we're trying to understand as we do a CFI analysis. Really quickly, let's just look at Chipotle. I would have asked you, and I'll pause here if you're watching this on video, pause the video, try and figure this out for yourself. Right? But if you're cheating, you just want to hear it, here's the key, because we're about to run out of time. I'm just going to look at the total. Right? So, going through the same steps. Chipotle, $968.9 million of free cash flow over a 5-year period of time. They generated $1.8 billion of gross cash flow, reinvested at a 48.3% rate, ended up with free cash flow before acquisitions of $968.9, pretty much didn't do any acquisitions. So Chipotle was just focused on building out their stores. And here's what's interesting. As Chipotle was growing, and you can clearly see the growth in the gross cash flow, they were generating so much cash profit that they didn't need to borrow money to fund the stores. And they were still having 50% left to pay out. That's impressive. Because a lot of companies, when they're in high growth mode, have to borrow to fund the growth. Chipotle was self-funding the growth by the profits from their stores and maintaining a very high growth rate. Right? So, non-operating, Chipotle took $968 million, and they did what with it? They put $436 million into excess cash. So they put money into the piggy bank. So think about this. Not only were they growing and opening up a lot of stores, they were using the cash not only to fund all that growth, they still had $400 million to put in the bank on top of all of that. Right? Then, with the other non-operating investment, they ended up with $140 million to pay out. They didn't really have any debt. Some short-term debt apparently with interest, but no long-term debt. They didn't increase any of their debt. So really, Chipotle basically didn't pay any dividends, bought back a little bit of stock over time. So again, think about this. For such a young company, unlike McDonald's, growing, opening up stores, getting bigger, huge investments, generate enough cash to fund all those investments, put money in the bank, and buy back stock with no debt. That's what I'm telling you. Before they hit the ditch, this was like a terrific financial story. And that's why investors really like Chipotle. Till the unexpected E. coli scare happened. Right? Now, we can look and see how the rest of the story is played out in 2015, 2016. But this is what I mean by insight into what's happening with the company. And you can see very clearly when we look at McDonald's and Chipotle as peers, how those companies look completely different. So, questions about any of this? Real quick, before we leave. All right, look for your homework assignment at the end of the day. We'll do more of these practices next week. And again, we'll cover more of this in class on Monday. Okay, have a good weekend.